we want to bring into the discussion to keep going with what's happening with these markets, Sam Stovall. He's CFRA's Chief Investment Strategist. Good to see you, Sam. In a most recent note, you talked about something I guess we're witnessing right now, although one day does not necessarily a trend make, but that's what you call the small stall. The Russell 2000 is off barely 0.5%. It's had some tremendous gains in the last 6 months. But what do you want investors to know about the, quote, small stall?
Well, Adam, I think that investors should realize that something going up is not going to be going up forever, and that it can get ahead of itself. Think of it like a military unit that has far outpaced its supply lines and needs to stop or at least slow down to let them catch up. We were trading at a 40% premium to the rolling 200-day moving average on the Russell 2000, and the S&P Small Cap 600 was recently at a level not seen since about 20 years ago when the tech bubble was about to burst. So my concern is that we're likely to see some rotation out of the small caps, just as we're seeing rotation out of value right now, moving into other more attractive and less expensive areas.
And Sam, going off that, I mean, what's your read on the tech sector right now? Because I think day in and day out, a lot of investors are kind of getting whiplash here. It seems like one day or a couple of days in a row, investors don't see any reason to buy some of these big tech names. And then other days like today, you have Apple up just over 3%. Is this the type of volatility that we could expect going forward?
I think so. Traditionally, we have 50 days in every calendar year on average in which the market has risen or fallen by 1% or more. Last year, we had 110, and I would not be surprised if we were on the high side this year as well. In terms of technology, certainly I think that because interest rates have been coming down is what's giving investors reason to be moving back into the tech, because with rising interest rates, that makes these very high growth oriented stocks look less attractive from an intrinsic value perspective. But again, if we move too far too quickly with the value side, then some slight rotation takes place. And that's what's occurring right now, in my belief.
Sam, help us understand, though, why. Because if you look, and I'm looking at another monitor right now, but if the 10-year, if the yield's around 1.7%, it's a little less than that. But it's up, what, 60 plus basis points in the last 6 months. And yet we're seeing this big sell-off in the most popular big tech names with only basically a 0.5% gain in the yield on the 10-year. Why? I mean, they're the biggest of the big.
Well, we started the year at 0.93 on the 10-year. We moved up to 174, and so probably not a surprise as to why the NASDAQ was then off by about 11% in the same week in which you had the Dow, S&P, and Russell 2000 hit new all-time highs. So I think right now what's happening is a lot of investors believe we're getting close to the period in which the music is going to stop. And so they are making their moves fairly quickly in and out of growth and value, tech and other areas, and basically adding to the overall volatility. And I don't think it's driven too much by day-to-day or minute-to-minute moves in the 10-year yield.
Tim, you mentioned those all-time highs that we reached. What was that, last Monday, when we saw the Dow, the Russell 2000, I believe, and the S&P hitting record highs. But when we look ahead and we do continue on this upward trend, what are some of those positive catalysts that you think are still on the horizon for equities?
Well, on the horizon, I think that as the year progresses, as the stimulus package and low interest rates work their way into the economy, the second half, I think, is going to be very strong. I believe that we're looking for about a 5.5% gain in U.S. GDP in 2021, but most of that is going to occur in the second half. I think that earnings right now expected to be about $170 plus for 2021 and $200 for 2022. I think we're going to see those numbers move dramatically higher, and that's what's going to sort of serve as a tractor beam to pull the market up as the year progresses. But volatility, I think, will be the name of the game.